GM, good morning. Welcome to the Milk Road Show, the daily crypto show where it's always Uptober. I'm your host, John Gillen. Today we are joined by one of Bitcoin's finest gentlemen, James Lavish. James is the co-founder and managing partner of the Bitcoin Opportunity Fund with over 30 years of experience in institutional investing and risk management. He authors the Informationist newsletter, simplifying complex financial, economic, and investing concepts for a wide audience, as well as bull posting Bitcoin. Today, we're going to discuss the debasement trade going mainstream. Is this a top signal? Is it the start of a new rally? We're going to talk about Bitcoin. What's going on? Are we going to see a blow off top or just keep grinding into 2026? And I also want to get his thoughts on the macro picture because I host the Milk Road Macro podcast and James is a macro expert. So if all of that sounds good to you, make sure you like and subscribe, share this episode with somebody who's going to enjoy it. And as a reminder, before we dive into today's episode, I want to tell you all about something that's changing the game, Milk Road Swap. With Milk Road Swap, you can seamlessly trade on Ethereum, Base, Arbitrum, and Solana all in one place. There's very low fees. We built this because we wanted to use it, and so we're sharing it with all of you as well. Click the link in the description below to check that out. Today's episode is brought to you by Nexo, the platform that grows your crypto without locking it away, as well as Figure Markets. Grow your cash like a bank, no lockups, just real returns. And without further ado, welcome to the Milk Road Show. James, how are you, sir?
Hey, John. Good to be here. Thank you for having me. Looking forward to our discussion.
Me too. It's a great time to have you on the show. I wanted to start with something that I think got a lot of people's attention. JPMorgan recently published something discussing what they're calling the, quote, debasement trade and how it's benefiting hard assets like gold and Bitcoin. You and a lot of other Bitcoin investors have been pounding the table on this thesis for years. How important is it to you to hear this coming from an institution like JPMorgan?
Yeah, so what's interesting about it is that it was echoed by Morgan Stanley yesterday too. So I even put out a tweet about it being the two Morgans are now jumping on board. What's not interesting is that they're recognizing that there's a problem with the Treasury, Congress overspending, fiscal deficits, leading to the need for the more issuance of more treasuries. And that is, that's kind of pushing long-term yields down. It's, up, meaning that the expectation of the long-term inflation in the United States and on the U.S. dollar is growing. So that's pushing the prices of those bonds down as people are not, there's just not as much demand for them. And so that's typically it's been your risk off asset for many years. But when you run negative real rates, as we have for about 15 of the last 20 years or even more, then investors start to wonder, like, where can I hide? The obvious answer is gold. And gold has been a store of value for thousands and thousands of years. It's been, you can look at gold and take an ounce of gold and go back to Roman times, buy a beautiful toga with 1 ounce of gold or 400 loaves of bread, and you turn around today and it's about the same thing. You can buy a beautiful custom-made suit or around the same 400 or 500 loaves of bread with an ounce of gold. It hasn't changed. So it stores its value. And investors know that. Is it a risk off? Like, is it a riskless asset? Of course not. There's nothing that's riskless. But what investors are realizing is that there's a need to get out of dollar-based, dollar-denominated risk-off assets like treasuries. There's a few reasons for that, John. And one primary reason is when Russia started the war with Ukraine, we turned around and in a catastrophic mistake, Biden turned off their access to the SWIFT network and seized the U.S. treasuries that they held. I mean, it was just catastrophic. That basically signaled to the world that, hey, if we don't like what you're doing, then we're gonna seize your assets that are denominated in our treasuries. And, I'm pretty sure that there's not a worse message to send the world that you need buying your treasuries than to say that, we may take them from you. Even though we need you to buy them, we're going to take them from you. So that kind of started this whole conversation with BRICS, with the Brazil, Russia, India, China, and South Africa starting their own currency. That's not really what's happening. They're just trying to avoid the exposure to U.S. treasuries. All right, so now you get into where we are today. And today we now have these relentless John, these relentless deficits that they're not going away. We have a president that was elected that said he's going to do his best to balance the budget, and he put people in place to head up what's called the Doge Commission. For those who know what that is, who don't know what that is, they were supposed to cut costs and get us closer to a balanced budget and maybe even a surplus. The reality is that the math is not; it just won't work. I've written a lot about this in my Substack newsletter and about the debt spiral and how the math is not going to work with the structural deficits that we have because of expenses that are in place through legislation that you can't cut. And so, they took off a few $100 billion, which is a lot of money, but in terms of what we spend a year of $7 trillion, it was like moving, chairs around on the deck of the Titanic. So the world's recognizing this, and they recognize, there's just no way that if the U.S. is not going to get to surplus. And for those who are saying, yeah, but Clinton did it. He did it way back. No, that was just accounting. It was kind of accounting magic where they were borrowing Peter to pay Paul, and it wasn't really a surplus. So we just don't run in surplus, and we haven't basically since the 1971 Nixon took us off the gold standard for good. It's easy just to spend, issue more debt, borrow more, and then what happens when you have fiscal deficits like this? It's inflationary. It creates inflation. It debases your currency, meaning that your dollar becomes worth less. So if you had $1 sitting in the bank in 2020, that dollar is now worth 75 cents. And just 5 years later, it's down 25%. And that kind of tracks with the 10-year down 50% kind of average of what happens to your dollar. The world is recognizing this, and they don't want to hold U.S. Treasuries. You've seen a decline in holding of U.S. Treasuries. So what are they buying? They're buying gold. The central banks around the world are buying gold. And that's why gold has shot up to now almost. We're looking at a gold price today that it's just mind blowing. That is now it touched 4,000 yesterday. All right, so it's up over 100% from just a couple of years ago. Now, what else are they buying? Well, of course, people are buying securities and houses and other things to store their value. But what's interesting about this, to get to the punchline of what your question was, is the debasement trade is now these banks are starting to talk about Bitcoin in the same sentence, not the same paragraph, not the same story, not the same book, but the same sentence as gold, which is they're saying, hey, look, this is digital gold. We understand it now. And if you have not done the work on it, you should do the work on it to understand it better, to understand why this is such a strong store of value, and that this can be as good or better of a store of value than physical gold for a number of reasons. Your Bitcoin followers understand this fully, and I'm not going to go into that and bore them. But this is really significant because now you've got these big institutions that are they're giving the green light to their analysts, their portfolio managers, and their customers to say, hey, look, you should own a few percent of this in your portfolio. And that's echoing Ray Dalio, who said it just a few weeks ago. He said you should own 15% of your portfolio, as much as 15% of your portfolio in gold and Bitcoin. He said he likes gold better. I mean, he's old guard, of course he does, but he understands Bitcoin. He thinks that that's, for the younger generation, that's where they're going to go. And it's not like this. What's most significant about this is that they're starting to understand, like the conversation is changing dramatically from just a few years ago, where it's a Ponzi, it's worth nothing, it's rat poison, it's got no underlying value, it's going to zero. Jamie Dimon saying these things at Davos, and now turn around just a couple of years later and boom, his own bank is putting out a piece saying that you should own some of this as the debasement trade. And that debasement trade is what we just described, which is watch out, as your dollar gets debased, you need to own assets. And these are the best horses to own in this trade.
James, I really appreciate that context, the macro backdrop behind all of this. And one thing that really stands out to me from what you said is like, you're right. These institutions are saying gold and Bitcoin, which is much different from just like mentioning like some people are using it's they're including it now in the same sentence as you said. It's a huge shift. Another shift that you talked about is how there's a lot more institutions recommending an allocation to Bitcoin, to crypto. Morgan Stanley, as you mentioned, their global investment committee is now recommending this. I think just came out this week, a 2 to 4% portfolio allocation to crypto. They're not the first institutional wealth managers, like you mentioned several others. BlackRock has also been saying 2%. How are you thinking about this in terms of like what it means for the market and investors? Is this a top signal that's like, okay, now the debasement trade has been figured out by everybody and it's so sort of played out, or is this going to kick off a new leg of bullish momentum and push Bitcoin even higher from here?
Yeah, it's a great question. And I get this question a lot because people say, well, you say the institutions are coming. We have the ETFs, they've got $100 billion in them now. So the institutions are obviously here. And that's not really the case. When I say institutions, like we're talking about BlackRock has their ETF IBIT. And if you pull up the list of holders, it's not your big institutions. It's not your corporate treasuries. Just pull up, let's see, if you pull up IBIT and you pull up holders, you can see in here that, you've got Goldman, Jane Street, Millennium, these are like, you've got some momentum stuff in here. But by and large, you're looking down here at Morgan Stanley, you're not seeing the big institutions like Texas Teachers or, CalPERS or Guggenheim, like they're not really in here yet. You've got Citadel, you've got Pine Ridge, Harvard. Yeah, they've got some. That's interesting. That's good. That's a big endowment. But do you see a lot of those in here? No, you don't yet. So we're still in early stages of these institutions figuring out like, what is this Bitcoin thing? How is it different from any of the other 20,000 cryptocurrencies? And they're not allocating to it yet. So those are the institutions that I'm talking about. When we talk about the big boys, those are the ones that have to start piling in and top of each other. Okay, why does it matter if you have a Harvard that comes in? That is significant, and I've seen that before. It's significant because if you go back to the 90s, where you had the portfolio manager, the CIO of the Yale Endowment, David Swenson, and he was there, and I actually took an investment class from him when I was there, and he was a young guy at the time. And he blazed this path for endowments to go and buy things that were a little bit further out on the risk curve to your typical investor. So when you're an endowment, typically they were buying stocks and bonds by and large in different mixes from different sources. Okay, they were not doing things like private equity, hedge funds, arbitrage funds, convertible arbitrage funds. Like they were not moving out on the risk curve, certainly not doing venture capital. Well, David started layering these things in, and his returns were exploding while everybody else is looking around saying, well, how is Yale doing so well? And they start looking at their portfolio and like, oh my God, we've got to get in this stuff. And then everybody started piling in. So now you've got the back end of that trade where you've got these endowments who are sitting on decades of private equity that they're trying to unload because there's no liquidity in them. And so they're selling them for not pennies on the dollar, but at a discount, some of them, because they need access to cash. So now you're going to see the same sort of thing that's happening here with Bitcoin slowly. I don't expect it to happen overnight, but it takes time. I actually gave a keynote out in Prague about this at the Prague Bitcoin conference. And it was all about the institutions coming in. And the problem is, John, is they have these steps they have to go through. Like it's structurally slow for a reason, but they have to go through committees and they've got to go through approvals and they've got to write papers on them. It takes so long. It doesn't, like, this is not the kind of thing where You and I are sitting home at night after eating dinner with our wives, and you just sit down on the computer like, I gotta buy some Bitcoin, and you just click a button and boom, it's done. This is like, you've got an analyst who presents it to portfolio manager. The portfolio manager takes weeks or months to even buy into it, does his own research, realize, oh yeah, Bitcoin is a little bit different. Maybe we should buy some of this. And then he's got to tell his chief investment officer, they got to sit down in front of a committee, that investment committee, and the investment committee's got to all vet it, and they've got to vote on it. And then it goes through the general counsel, like what's the risks, what are the personal risks? And then you get to the personal, reputational risk of buying it. And that is a big hurdle, because if you're looking around, nobody else owns it, and you go out on this curve and you own it, and then the thing has one of its 80% drops, you lose your job. I mean, you're putting yourself out there. What's the upside to that, rather than just stay in that stream to keep getting paid, pretty handsomely to just perform, not wildly outperform, just perform. And so that's a big deal for these institutions. You've got people sitting in these seats for many years that they don't want to give up that seat. So they're going to be very careful, and they're going to be a little bit more risk averse. So what you're seeing here is very interesting, in that now you've got JPMorgan, Morgan Stanley, BlackRock, Fidelity. You've got these big companies. Bitwise is all about these kinds of instruments, these securities in their ETFs. And so now you've got these huge sell-side institutions that are saying, it's okay, come on in the water, it's okay. And even Vanguard, who initially absolutely vehemently just refused to offer the access to IBIT or Fidelity or FBTC to their own clients, absolutely refused. Well, a year ago. Well, since then, Bitcoin's up about 150%, and that CEO is gone. A new CEO is brought in who helped structure some of these ETFs. He understands them, and suddenly, lo and behold, they announce, we're considering giving access to our clients soon. It's becoming a risk to not have access, to not have any allocation to it, and that's what the world is recognizing. So, to answer your question, we're just beginning. And no, I don't think that this is going to cause this blow off top. But I do think that this is a structural shift that's very significant, and it will last a long time. It doesn't mean that we're not going to have drawdowns. It doesn't mean that Bitcoin won't still react like a risk asset like it has for years. But it does mean that understanding is changing slowly, but it's changing. And that as it's brought into this conversation with gold, that's going to change the way that it correlates to the risk assets of the world. And it's a pretty significant change.
If long meetings and judgmental bankers are your thing, Nexo's probably not. Nexo is a premier wealth platform built for people who value their time and money. It's built for people who have idle cash lying around and want it to grow fast. Whether it's Bitcoin, Ethereum, or even Forex-pegged assets like USDT or USDC, Nexo offers up to 14% annual interest and access to crypto-backed credit in under 24 hours. Your assets need a platform built for growth. Join Nexo.
Why do people invest in real estate? Because it spits off cash flow. But I'm not here to manage rental properties. That's why I'm looking at Figure Markets. Their new democratized prime product backs your money with real cash flowing assets and returns up to 9% APY. It's the first real world asset borrow lend pool built for everyone, not just institutions. Ready to lend like a bank and get more than the 5% Aave is offering you? Download the Figure Markets app today and get 9% on your idle funds. Go to milkroad.com/Figure Markets.
I really appreciate the thoughtful analysis on that and framing for our audience how a lot of institutions are thinking about this and letting us know your views on this. I did want to ask about that, like Paul Tudor Jones went on CNBC and said he's calling for a blow off top in Q4. I want to get your thoughts on Q4. JPMorgan, in their writing about the debasement trade, said that they think it could push Bitcoin to 165K this year. And like I said, Paul Tudor Jones is calling for sort of a blow off top. I'm curious what your mindset is going into Q4. I know you don't like short-term predictions, but do you see Bitcoin at 150K, at 200K? Do you think 165 makes sense? What are your thoughts for Q4 as we see this sort of adoption and new wave of capital start to come in for the first time?
Yeah. So first of all, I've been talking about Bitcoin getting to 150 to 180 for a long time, for years here. And I figured sometime in the fall. I thought it was going to hit 150 to 180 sometime in November. I guess it's not out of the question here. You know, I mean, Josh Mann thinks it might go to 444. I don't know about that. But I do think that we're going to see an expansion in the price of Bitcoin here, because we're seeing an expansion in liquidity. And what's happening is you've got the central banks are easing. You've got the Fed is now easing, and you've got some factors here that are going to cause it to continue to ease. You've got China, who is expanding on their liquidity and their money supply, and that is going to start feeding into risk assets around the world. Japan has been, if you're watching Japan, they have a new prime minister who was just elected that is akin to Trump. And the thought there is that liquidity is not going to stop in Japan. And even though they are in a precarious position of being the largest buyer of their own bonds, the largest owner of their own bonds, having done yield curve control for many years here, and now sitting at a spot where their yields have spiked up significantly. And so what's going to happen there? Well, the idea is that the thought is that, look, this has been the carry trade for the world, where you can borrow yen cheap, and turn around and buy risk assets around the world. It's just access to capital on the cheap. And the thinking is that that's going to continue now with her in place. So that's a big deal. Another big deal is that, as we've seen just this dearth of volatility in both stocks and bonds recently, that means there's access to more capital, because it requires less collateral to borrow against. So that's an expansion of liquidity. I talk about Michael Howell a lot. Cross-border capital. He's got a great liquidity measure that he likes to look at, that I think is probably the best that I have access to in the world. I really respect the work he's done. I don't know exactly what his calculations are, but I know what's in the pot, and so things like bond liquidity, bond volatility, shadow banking, meaning hedge fund and private capital, the central bank, the QE, QT, like all that stuff is in there. And that's really the measure beyond M2. M2 is one big factor in it, but then overarching all of that is just, we're a world built on debt, on leverage, on borrowing. And that's what's going to keep driving this. And I believe that that's going to keep expanding through this year and into next year. And that cycle of liquidity is just continuing up here. And it's going to probably top out sometime next year. So the answer is, I have a high degree of confidence that we're going to continue to expand. Do we have a blow off top? Well, it would seem that that's where the market wants to go here. Just if you look at the emotion of stocks, if you look at the psychology of them, we just keep reaching new highs. It feels like we're going to get to the point here of just absolute ridiculous FOMO across the board. I don't know when that is, or how that plays out for Bitcoin, but it just feels like that. And it feels like I feel the echo of 1998, 1999 here, where you had all those internet stocks. And, it was just madness. You're too young to remember this, but it was, you would buy an Amazon or a Google, it would be up 20, 30, 40% in a day. You're just like, wow, do I sell it? What do I do? And then it's up another 40% the next day. You're like, oh my God, what is, this is just insane. Especially the smaller ones, not the bigger ones like those. But so the problem with the market is that the breadth is very, very consolidated with the AI, the Mag 7s. That takes up the vast majority of the index now, and that's a little bit worrisome. And but if you look at the indicators of what's going on and where the Fed is right now, which is they're a big driver of liquidity. I just expect liquidity to expand going into this quarter, and so I'm continuing to be long. I have hedges on in case we have some sort of black swan event. Best we can do, but by and large, we are still invested.
So one of the first guests I had on my Milk Road Macro podcast was Michael Howell. So if anybody missed that episode, I suggest you go back and check it out. But I think that's a great place to start from, is that liquidity point of view. And then this idea of concentration. I had Jordi Visser on last week, and he talked about that concentration in AI as well. So yeah, just again, a lot of really helpful perspective on that. I want to ask your thoughts on something here. The Bitcoin bull run that we've been in this time has felt much different in many ways than prior bull runs. There's been a lot less euphoria. And I think a lot of people, especially viewers of this channel, people who are in our Milk Road Pro community, crypto investors in general, are feeling like we've been in a steady grind, but we haven't really had much of like a big, massive breakout. How are you thinking about this change in dynamics? How are you thinking about this in terms of like how the market is treating this asset class differently? Is this a sign that it's maturing, or are the big returns gone from Bitcoin and crypto and those days are kind of behind us? How do you think about this changing market dynamic we've seen?
Yeah, so there's a few things to unpack there. First of all, the old thinking, or the traditional thinking on Bitcoin, traditional, it's only been around 15, 16 years, but was that as you get through these market cycles, these 4-year cycles, they were attached to the supply. So the mining and the reward and the halving every 4 years. Well, that is absolutely, I believe that is absolutely the huge driver beginning in the first few cycles. But now as we get along here, and that reward becomes less and less important for just the number of Bitcoin that are out there, and just as a percentage of the new supply, it just becomes, it's not as important. What is important is the hash rate and the cost to actually mine these things. Number one, access to energy too, which they're finding all kinds of ways to mine for just pennies, per kilowatt. So that's one thing. But really, the big driver of this latest cycle, I think, is getting much, much more closely tied to what we just talked about, the liquidity and global liquidity and expansion and contraction of that liquidity and money supply. And so, and you're seeing that kind of in real time on a lag. What do I mean by that? Well, when you look at somebody like Michael Howell's work, he'll plot the liquidity, and then he'll plot Bitcoin on a 10 or 12 week lag behind it, because it takes that long for that liquidity to see itself, to see the liquidity driver in the price of Bitcoin or in the price of gold. So it's a little bit different than securities. So that's one thing. The other thing is, if you look back at the 4-year cycle, what's interesting is that it matches up perfectly with our presidential cycle. And this last presidential cycle was extremely important. And what I mean by that is that we had a quite an antagonistic cabinet previously, and administration as a whole, through Biden and his administration, and particularly the psychopath out of Massachusetts, Elizabeth Warren, and her anti-crypto army. I can't imagine a worse senator for the citizens of Massachusetts, but they keep electing her for God knows what reason. Just lining her pocket every year in her insider trades. But anyway, so the interesting thing is that when we had that election, you could see the run up to it, and people realized that Trump was really gaining momentum here, that the mainstream media was completely wrong, that he had a lot of support, and suddenly that quiet support he has was getting more and more emboldened. Flash forward today, it's very emboldened. But the thing is, when I launched my fund, the Bitcoin Opportunity Fund, John, which was right before the election, It was in 2023. And we experienced firsthand what became known as choke point 2.0. And for your viewers who don't know what that is, choke point 1.0 under the Obama administration went after industries that they didn't like. Things like firearms, guns and ammo, pornography, and what they said was, if you're a bank and you're doing business with these companies, with these outfits, that we're going to come after you. And so that was known as choke point 2.0. It was pretty much behind the scenes, and they just choked off all of these businesses by the access to actual capital through the banks. If you don't have bank capital, bank access, then no surprise that something like Silk Road would pop up. But flash forward to the Biden administration, and Elizabeth Warren decided she didn't like cryptos. And so she was going to go after the crypto companies, the crypto bros. And so any business and any bank that was doing business with them was going to be scrutinized, and possibly have these long drawn out audits or whatever it may be, sanctions, quiet sanctions. And so, and we experienced it. So when we were raising our fund, we call it the Bitcoin Opportunity Fund. And so, and it's Delaware, it was formed in Delaware. So we're a US based company under Delaware rules and operating in Nevada under Nevada rules, and all above board, we did all our registrations with the SEC above board. Everything's laid out to see. But because we had Bitcoin in the name of our fund, we're just a traditional hedge fund investing in Bitcoin companies, but banks refused to send wires. They would delay them. They debanked a couple of people who were trying to send money to us. And then they just cancel them. They would just cancel wires that were sent. And so flip to the 2024 election, when we get a new administration, and suddenly all of that, the SAB 121 was repealed fully. For going back to the people who don't know what that is, a little bit more, just a little bit deeper here, John. SAB 121 was when the SEC did an end zone run around Congress and decided they're going to do an accounting bulletin that basically said, if you're a bank and you're doing business with cryptos, you're holding Bitcoin for a customer, then you have to put in your balance sheet as a liability. And it was messy. And so nobody wanted to do business with any crypto companies, any Bitcoin companies. And so Congress got angry because they saw it as an end zone run. They're like, you can't just do a bulletin. Like, this needs to be legislative. So they overturned it, SAB 121, through a vote. It got to Biden's desk and he vetoed that overturn and said, no, we're going to keep it in place. Well, one of the first things that Trump did when he came in is he said, well, we're going to undo that veto. We put in a new commission, the SEC, and they issued something called the SAB 122, which overturned 121 and said that it's okay for banks to start doing business. So why do you think is it surprising now that you have JPMorgan and Morgan Stanley suddenly saying, maybe you should own some of these? Oh, and by the way, we're going to be offering this through our platforms. Come on. So, but we've had one wire that had trouble in the last, since the election, and we launched a new fund, Bitcoin Opportunity Fund 2, and we've had one wire that we had trouble with, and it was coming out of Canada, and so it's completely switched, and so that's been a big deal. Yeah.
I really appreciate the history lesson around this. I think we're not going to have time to get to all the questions that I have for you today, but I really appreciate you sharing the history and context on these things. I do want to ask one question, though, about the Bitcoin Opportunity Fund, because shifting away from Bitcoin, the asset, there is a large ecosystem around Bitcoin, and you guys do investment in public and private companies. I would just like to know a little bit about your work with the Bitcoin Opportunity Fund. What has you excited about the Bitcoin ecosystem, right? Because a lot of people will say Bitcoin is just a way to send coins to one another, and there's not much else you can do with it. But what are you seeing in the Bitcoin ecosystem that's got you excited as an investor, and what innovations are you seeing coming out of the Bitcoin ecosystem?
Yeah. So, well, yeah, I appreciate you asking about this. The Bitcoin Opportunity Fund it's a traditional hedge fund, and we invest in only Bitcoin adjacent companies or projects. And we do early stage, late stage, we do private and public. It doesn't matter wherever we see the opportunity, but our core focus is on more developed companies. And we like to say they're real companies with real revenues and real profits. And so we do a lot of public investments. We've done quite a bit of these new Bitcoin treasury investments. We've been in mining, we've been in energy. And so we do some venture capital, a few here and there. But by and large, we're really focused on that core. And the reason for that is that, we're a hedge fund that's got a 7 to 10 year lifespan. And so we want to have companies that are going to match that duration. And, this is an emerging technology, and it's taking a long time for these early stage companies to get up and going and really get traction with their technologies and their innovations around Bitcoin. And I just think that cycle for them is long. It's more like 12, 15, 17 years. It doesn't really match that, that 7 to 10 year fund, so you want the investment fund and that life of that investment fund to the duration to match your investment. So we feel like we can match our investments better here. But one of the things that's important, John, is that we can do, and we do a lot of, is we can manage the risk around these investments. And so our objective isn't to beat Bitcoin, is to beat Bitcoin on a risk adjusted basis. So to manage that volatility. So if you do need access to funds, you're exposed to Bitcoin along the way, but you're less exposed to those violent drawdowns that we see. Now, we do have some massive gains and retreats in some of these treasury companies, and that's just part of the game, that you'll have markups and markdowns because you're doing these private investments that haven't come to market yet. But because we have access to those private deals, the pipes, what we call them, is we get them at a better price because we're taking the risk of being illiquid until it comes to market. So we get them at a price that's much closer to 1 MNAV rather than having to wait to buy them in the market when they're 2, 3, 4, 5, 6 or ridiculous MNAV. But that's one of the things that we're really excited about. I think there's a great amount of opportunity there, and we're seeing companies like primarily MicroStrategy waded into this world, and through some highly intelligent financial engineering, they've found ways to access liquidity. And really, what they in the beginning, they were just kind of arbitraging the capital markets and the fiat system to borrow dollars. The debasement, the ultimate debasing, the debasement trade is to be borrowing these things and buying Bitcoin and gold. But buying Bitcoin is the ultimate one, where you're able to engineer, where you can issue preferreds and offer a super attractive 8-10% yield, and pay for that yield along the way with that tremendous growth in Bitcoin. And so that's been a development that we think is going to continue for a long time. We think this has a long runway. Now, that said, not for everybody. There are some companies out there that I don't have as much confidence in as other companies, and I think that it's going to consolidate down to a handful of really successful companies that are public companies that are able to continue this capital markets access and arbitrage to fiat and to the US dollar. I can't say much about Strive because I just joined on the board of directors, and I have to be careful about that. But I'm excited about that. I'm excited about being part of that company, and the things that we're talking about, we're excited about. We think that there's a long road ahead. Again, I can't talk about the merger that we just announced, but these are things that I think are going to continue down the road. You're going to see more consolidation, and you're going to see this continued access to capital. There will be volatility. Full stop. I do not expect to go through the rest of this cycle or into the next one without tremendous volatility. I do expect that, but that brings opportunity, and that's really what our fund is looking for, is those opportunities to take advantage of.
I want to end this conversation with coming back to opportunity and hope, and a question about financial nihilism. I really appreciate this perspective that you're bringing. We talked about the debasement trade and how this is being driven by people losing faith and confidence in the bond market. We talked about Operation Choke Point 2.0 and how this oppressive regulatory regime has been kind of choking this industry for a long time, and how that's changed. And I asked you about our Milk Road Pro community and other crypto investors feeling sort of like a little bit hopeless, I think, and that's where this idea of financial nihilism has come from. People of my generation and a lot of, I think, crypto investors are struggling with this a lot. And I'd love for you to just sort of tell us a little bit about why, in the face of all of this and these big international level problems in the financial ecosystem, why should crypto investors, Bitcoin investors, feel hopeful about their futures, their financial futures? And just talk a little bit more about that opportunity that Bitcoin brings and what that offers to investors.
Yeah. So if it is troubling. It's super troubling. I wrote a piece about the separation of wealth in the United States and how we're starting to look more like an emerging market. Like a Chile or a Brazil or an Argentina, with the separation of wealth in our country. There's a reason for that. The reason is the Cantillon effect. The Cantillon effect is where whoever's closest to the money spigot, where they print the money, they actually print the money. Whoever's closest to that benefits the most. And there's no surprise. There's no secret around that. That's why the bankers, and that's why the politicians, that's why these guys are getting stinking rich, and their wealth is consolidating at the top. So the top 1%, controls a massive percentage of the assets in this nation. And so if you don't own assets, you're getting left behind. Why? Because of that debasement of the currency. So you can't just sit and the problem is wages aren't keeping up with inflation. They lag. And then when they finally do catch up, everything is so expensive. Like, how are you going to buy a house? How are you going to buy that car? How are you going to pay for that car that you bought that suddenly is like the payments on it are just crushing you, because you're paying for the percentage of your discretionary income going to goods that you need, the food and clothing and shelter, it's growing, and it's taking away your ability to do anything else, no less save. And so it's a troubling problem that we have. And for the first time, we have this asset that you have access to with your phone. Just pick up your phone and you can log into a Strike or another exchange and just go buy some. You could buy $10 worth, $5 worth. You could just do it every single day or week or month or whatever you can put away. And suddenly you have this asset that cannot be debased, like the US dollar, like the yen, like the euro. You can buy this asset, and it's not going up in value, it's that everything else is going down in value around it. And so even houses are going down in value against Bitcoin, tremendous rate, at a tremendous rate. And so owning Bitcoin in particular, the fact that it just cannot be debased, that is written in the code, that is there's only going to be 21 million of these ever, that there are over 60 million millionaires in the world that would eventually love to have a full Bitcoin themselves, but they can't and they won't. And you have access to it now. And the access to it is really around the knowledge. And what gives me so much hope and so much optimism and confidence is that for the first time, you've got regular people who are on outside Wall Street. And I've straddled both worlds now for years. And I see the people in Wall Street who are just completely oblivious, or they just shut it down, or just don't want to think about it, because this is not something that they have benefited from. And they've benefited from that old system for so many years. Why would they consider something new or help it unless there was tremendous opportunity for gains themselves there? And so, but the little guy, the individual investor, the retail guy who's sitting at home looking at his bills and saying, my God, if I just had something that I could put away and just not worry about for the next 10 years, and I could save in it that won't melt away on me, and it's not illiquid like a house, or doesn't require payments or mortgages or taxes like a house. If I just had something like that, then maybe I could get out of this hole. And we have that now. We have it in Bitcoin, and they have not paid attention to it. They're just now waking up to it. Just now waking up to the fact that it's a separate trade than the Mag 7. This is the debasement trade. This is something that you can put your money away like you can in gold, put it in a vault and just leave it there. If you were owning gold for the last 5 years, now you're happy because you just left it there. If you were owning Bitcoin for the last 5 years, you're ecstatic. And I think that that's going to continue. And it's not that you're getting rich. It's like I said yesterday on the macro show, is that it's a way for you not to get poor slowly. You can have tremendous gains in it in the future for sure, especially if the system falls apart. It's not something I wish for, but if we have a period of insane inflation, I don't think that the dollar is going to hyperinflate anytime soon. But if we have insane inflation of 15, 20%, 25%, you're going to be okay if you have some Bitcoin. That's the ultimate. That's the hope. And that's why I think that, that you should be optimistic if you're around your age, and you're understanding this. And guys my age are sitting around on Wall Street and having no clue what's going on yet. That's a positive thing in my mind.
James, that was beautiful. It made me want to stand up and salute. I really appreciate you coming on the show today. I think our audience is going to really enjoy this conversation. I have a lot of other questions we're not going to get to today, but I got to get you on our macro show to talk about that stuff over there. But for now, just thanks for being here. Where can we send people to find more of you and your work online?
Yeah, so obviously I have my newsletter. That's the information. It's on Substack, and you can just find it at jameslavish.com. And if you're a credit investor and you are interested in investing in the Bitcoin ecosystem and want to broaden out your investments in Bitcoin, then you can just find us at bitcoinopportunity.fund. Just drop us a line. We're happy to get on the phone with you and talk through whether or not it would be appropriate for you if we think that you would be a good limited partner. So pretty easy.
Thanks so much for being here, James. I really enjoyed the conversation. I hope we can have you back again soon.
I would look forward to it, and I'll come on your macro show at some point soon.
I'm going to hold you to that. Absolutely. Great. Well, thank you, James. And thank you all for joining us. I hope that you all learned a lot today. And just remember, stay safe, stay bullish, stay educated, and we will see you on the next episode of The Milk Road Show. Thank you, everyone. Bye.
We're sending Kyle Reidhead, our head of research, to the UK's largest Web3 summit. I'm talking about Zebu Live, happening October 21st and 22nd in London. Want to join? Use our code MILK to get 20% off your tickets. Hit the link in the show notes and say hi to Kyle for us. Want insights on what's moving crypto markets and how we're trading each event? Subscribe to our channel and join the Milk Road Daily and Pro newsletters and start investing like the top 1%. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.